Many investors have a tendency to chase dividend paying stocks or dividend paying funds. Why? Because they love the idea of receiving passive income without needing to sell their shares. It feels like free money, never ending eggs from a golden goose. Some even go as far as believing that dividend stock investing is actually a superior way to invest in the market compared to just buying and holding a broad market index fund. However, I'm going to make a counter argument in this video, an unpopular one if you're a dividend lover. I'm going to argue that you should not chase dividends. That in actuality, when you choose to chase dividends, you're actually hurting your ability to maximize your wealth over the long run. So without further ado, let's get right into it. However, before we get there, just in case we haven't met, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Before we dive deep into why chasing dividends might not be the best idea, let's take a step back and understand the basics of dividend investing first. Here is Dividend 101. A dividend is simply cash that a company pays to its shareholders. Let's say you own stock in company XYZ, and company XYZ makes a healthy profit this year. The company has a choice what to do with that profit. One, they can either reinvest that profit back into the business, funding research, expansion, and new products, or two, they can distribute some of that profit to shareholders as a dividend, a reward for buying and holding their company's stock. And when you look at the broad stock market, you see a mix of both. Some companies, especially fast-growing companies, tend to reinvest almost everything back into a company to fuel more growth. Other companies, usually more mature, stable companies, tend to pay out dividends because they've already funded their growth. A good example of a company that consistently deploys the latter strategy is Coca-Cola. Now, we all know Coca-Cola for their famous, very sweet, very addictive sugary drinks. However, what many people don't know about Coca-Cola is this, that for the past 60 years, the company has paid a dividend to its shareholders every single year. But they didn't just stop there. They took it a step further. On top of consistently rewarding their shareholders with a nice dividend check every year, they've also raised it year after year. In 1990, Coca-Cola paid 10% per share in annual dividends. By 2000, that grew to 68 cents. By 2010, it was $1.76. Today, it's over $2 per share annually. Thus, many fans of dividends have consistently included Coca-Cola in their portfolio, regardless of how the market has been doing, because they just love getting that recurring dividend payout. However, if you're a serious stock market investor, you have to recognize that dividends, while they do account for a portion of one's investment returns, is only one part of the formula. The other part of the formula is the price appreciation of the stock. Price appreciation is simply when the stock price of a company goes up. You buy a stock for $5 and it goes up to $6. You had $1 appreciation. And the reason this happens is because the company is growing and making more money. It expands into new markets, it develops new products, it becomes more profitable. And because everybody wants to own a piece of a profitable company, demand goes up and the price of the stock goes higher and higher. And it is these two pieces, price appreciation plus dividends, that enables investors to make money in the stock market. They combine to what becomes our total return. Now, the obvious question is this then. What is better? If you want to make the most money in the market, what should you pursue? Price appreciation or dividends? And let me slow down here and emphasize this point because it's probably the most important part of this video. They are both important. Neither is more important than the other because they both contribute to your total success when investing in the stock market. And all else being equal, price appreciation and dividends are mathematically neutral. Each is simply a different way for investors to realize the same total return from their investments. Let me give you an example to show you what I mean by this. Let's imagine we purchase stocks of two companies, Company A and Company B. And let's say Company A, like Coca-Cola, issues a high-yield dividend stock that pays out healthy dividends to its stockholders year after year. However, Company B does not issue dividends. Instead of paying its shareholders a portion of its profits, it reinvests back into the company. And let's say you buy both stocks at the beginning of the year at $100. Now, Company A with this high-yield dividend stock pays a 5% dividend, so you get a $5 per share. And during the year, because the company has done relatively well, it also appreciates by 5%. Thus, the stock price goes up to $105. So at the end of the year, what do you have? You have $5 cash in your pocket, and the stock is worth $105. That's $110 total. You started with $100, you ended with $110. That's a 10% total return. Now, how does stock B do? Company B, unlike Company A, pays no dividends. However, this is the key difference. Because it reinvests all its profits back into the company to expand into new markets and improve its product line, it does much better than Company A from a performance perspective. Thus, while Company A stock only appreciated by 5%, Company B stock appreciated by 10%, making its stock price increase from $100 to $110. That is a 10% total return despite having paid out nothing in dividends. As you can see here, Company A and Company B had different dividends and different price appreciation. However, at the end of the day, they both gave the same total return of 10%. Different path, but the same outcome. One just decided to pay shareholders upfront, and the other one decided to reward the shareholders in the back end. Now, I know this is a super simple example, and I'm sure many of you guys have tons of questions. What if Company A and Company P are fundamentally different? What if one company is in a mature industry with limited growth, while the other is in a high-growth tech sector? What if Company A simply cannot reinvest to generate more profit, so paying dividends is a smart move? What if Company B reinvests, but wastes the money on bad decisions? Fair points and all legitimate questions. Not every company can reinvest profitably, and not every dividend is sustainable. And yes, some companies operate in industries where growth is limited. But here's what the math tells us. All those are questions about which companies to own, not about whether dividends are good or not. The dividend itself is not what's driving your returns. Profitability is. A company's ability to grow earnings and generate cash flow. That's what matters. Whether the company chooses to pay that cash flow as a dividend today or reinvest it for tomorrow does not change the math. You still get the money either way. The total return is identical. And studies have validated this fact for decades now. In the 1960s, two Nobel Prize winning economists, Merton Miller and Franco Modigliani, published a landmark research called Dividend Policy, Growth, and the Valuation of Shares. And it showed that dividend policy does not affect returns. They proved mathematically that investors should be indifferent between receiving dividends and price appreciation. The market does not care which one you get. Your total return is determined by company profitability, not by dividend policy. And since then, countless other academic studies have confirmed this. Whether a company pays out 100% of its profits as dividends, reinvests 100% of its profits, or does something in between, none of that predicts future returns. What predicts returns is whether the company becomes more profitable over time. So if the research has known this for 60 years, why do so many people still obsess about dividend-paying stocks? Well, let's cover some key reasons why. However, before we get there, while we're knee-deep in the topic of stocks, dividends, and returns, let me share with you a great free tool that can help you organize your investment portfolio. Which is why I'm excited to talk to you about today's video sponsor, Empower. If you're like a lot of people, your financial accounts are probably scattered everywhere. A 401k from your old company, a Roth IRA with a broker you haven't logged into in years, and probably a few checking and savings accounts at banks you're not sure are still around. It's overwhelming to keep track of everything, let alone plan effectively for the future. Well, this is where Empower's free personal dashboard can help. Once you connect all your financial accounts to the personal dashboard, not only are you able to see all your accounts in one place, you now have access to a powerful retirement planning capability, the Retirement Planner. The Retirement Planner automatically pulls in your current savings, investments, and contributions and creates a personalized projection of your retirement readiness based on your actual financial data. You can even account for major life expenses like putting your kids through college or buying a second home and see exactly how they affect your retirement timeline. No more guessing about where your money is, how it's performing, or if you're on track for retirement. And what makes this even better? All these features are completely free when you sign up. So if you want to stop wondering about your retirement readiness and start knowing exactly where you stand, I highly recommend you check out Empower today. Please go to my special link in the description below to get started with their free personal dashboard and powerful retirement planner. Again, I'll have the link in the description below. Alright, with that said, let's get back to the video. Let's understand why investors are still so obsessed with dividends. The simple truth is that our brains are wired to prefer dividends, not because of the math, but because of psychology. The number one reason why investors are obsessed with dividends: mental accounting. We, the investors, whether we know we're doing this or not, have a natural tendency to divide our investment gains into mental buckets. We have a bucket for income and a bucket for capital. And we see each bucket, psychologically, very differently. We perceive a $100 dividend check like a salary, something more tangible, while we perceive a $100 price increase, appreciation, associated with risk, something intangible because it can quickly disappear when the market turns. Thus, many people, especially retirees who are used to their salaries from their day job, have a tendency to gravitate towards dividends because it feels familiar. It feels safe. Even when math, as we saw earlier, proves that dividends and price appreciation are fundamentally equivalent ways to receive returns, our brains can't help itself but emotionally value cash income more. The second reason why investors are obsessed with dividends: loss aversion. When we receive a dividend check, it is ours to keep. It is not going to go away when the market takes a turn. However, price appreciation, one bad quarter, one bad news about the company or their product, and it goes straight down. And for many people, they have a really hard time stomaching that loss. And science has proven this fact. Nobel Prize winners Daniel Kahneman and Amos Tversky discovered that pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. Thus, when it comes to investing, $1 of loss creates twice as much pain as $1 of gain creates happiness. So many people have a natural tendency to choose a path that avoids potential pain, even if it means missing out on long-term gains. The third reason why investors are obsessed with dividends: self-control. For investors with limited self-control, dividends feels disciplined. Selling shares feels unlimited, so dividends feels like financial structure. Think about it this way. If you own a stock or a fund with no dividend and you need cash for living expenses, you have to actively sell shares. That requires a decision, a deliberate action. And for many people, that feels risky or psychologically difficult, like you're touching your nest egg. But with the dividend, the cash just shows up in your account. You don't have to do anything. It feels automatic, structured, and almost like it's not really coming from your investment. It's just money appearing on its own. What is interesting is that, as we alluded to earlier, again, if both companies or funds provide the same total return, the math is identical. It's just that with dividends, one feels psychologically safer, more disciplined, more in control. Alright, now that we understand the reasons why people pursue dividend stocks and funds, let's get into the real meat of it. Let's talk about the cost. The real cost of chasing after dividends. The number one cost of chasing dividends: you miss out on non-dividend paying companies. Over the past decade, who has been the best performing companies in the stock market? Unless you've been hiding under a rock, you can easily name them: Apple, Amazon, Nvidia, etc. Today, these are all trillion-dollar companies that are responsible for the majority of the stock market growth. But do you know what is interesting about these companies? They pay little or no dividends. That's right, these tech giants, instead of taking their profits and paying them out in the form of dividends, reinvest the majority of the money right back into their company to generate more profit. And in part, this reinvestment strategy is exactly why they've done so well. Apple didn't pay dividends for decades while it was building the iPhone, the App Store, and expanding globally. Amazon famously prioritized reinvestments of its profits for years, and to this day, still does not pay dividends. And Nvidia channeled nearly all its earnings back into R&D and innovation, thus transforming from a gaming chip company into the world's leader in AI hardware, cloud computing, and data centers. Now, during the past decade, if you've been a dividend chaser, if you constructed a portfolio focused exclusively on high dividend stocks, you would have massively missed out on the returns that these companies generated. The number two cost of chasing dividends: you become over-reliant. The truth that many dividend chasers forget is that dividends are never guaranteed. Take General Electric as an example. For decades, GE was a dividend aristocrat, a company that had raised its dividends every single year for 25 plus consecutive years. Investors loved it. They bought GE specifically for that reliable, growing dividend check. It felt safe, it felt dependable. Then in 2017, when GE faced headwinds, it slashed its dividends by 90%. Just like that. And all the investors who relied on GE's dividends suddenly had a massive hole in their income plan. And what is worse is that because many dividend investors who thought they were safe suddenly bailed out at the same time, the stock price collapsed as well. A double whammy. This is the cruel reality of dividend chasing. You're building your financial plan on something that can disappear overnight. And it's not just GE. We've seen this happen with other companies and industries. BP slashes dividend during the oil crisis. Banks cut dividends across the board during the 2008 financial crisis. And more recently during the pandemic, cruise lines, airlines, and hospitality companies, all high dividend favorites, eliminated their dividends entirely. This is why over-reliance on dividends is so dangerous. You think you're being safe and conservative, but you're actually taking concentrated risk without even realizing it. But you might be thinking, what if I pursue the ultimate diversification to mitigate this risk? What if I own both? A well-diversified fund to capture non-dividend paying companies, and a dividend fund to capture dividend paying companies. Because Tay, I still like the idea of dividend paying companies. And I agree, I like dividend paying companies as well, but there are smarter ways to hold them. The number three cost of chasing dividends: redundancy and extra fees. Let me show you what a lot of investors do in the spirit of ultimate diversification. They own a total market index fund like VTI or VTSAX. Then they also buy VYM, Vanguard High Dividend Yield ETF, or SCHD, Schwab US Dividend Equity ETF, thinking they'll capture extra dividend income. But here's a problem. VTI and VTSAX already own VYM and SCHD. You own the same companies twice. When you buy a total market fund, you're getting exposure to every dividend-paying company in the market automatically. So adding a high-yield dividend index fund or ETF on top is not getting you new returns. It's just concentrating your holdings, and you're paying extra fees to do so. Additionally, often high-yield dividend funds have higher expense ratios and higher turnover. They're constantly rebalancing to chase yield, which creates more trading costs and more taxable events. Bottom line, having a total market fund plus a dividend fund is like owning 2 gym memberships. You're paying double for the same access. Alright, so if we should stop chasing dividends, what should we do? Let me wrap up this video with 3 simple recommendations. Recommendation number 1, simple. Buy one simple broad market index fund and be done with it. Think of a broad market index fund like VTI, VTSAX, or any other fund that tracks the whole market. Why? Because these funds capture dividend income, naturally included, capital appreciation from all types of companies, and automatic tax efficiency. You get the best of both worlds. Mature dividend-paying companies and growth companies without the complexity. Recommendation number 2, if you need cash, sell strategically. Investors who buy the whole market still capture dividends naturally through their diversified portfolio. So don't be afraid to sell shares. When you need money, just ensure you're selling strategically. Selling to take advantage of long-term capital gains tax rates. Selling only what and when you need it. And timing your sales when market positions are advantageous to you. Bottom line, when you control the timing and the amount, you don't have to rely on a company's dividend decisions. Recommendation number 3, ignore the noise and trust the math. Stop obsessing over dividend yields, dividend aristocrats, and high-yield funds. The math is clear. Total return is what matters, not which bucket it comes from. Stay focused on owning the whole market, keeping fees low, and staying the course through the market cycles. That is how you win over the long run. Thank you guys for watching the line of overthinking investing. If you want to learn why high earners are some of the worst investors, please check out my video here. Until next time, all the best.